Let's talk markets and some stocks to watch now with Matt Powers, president and managing partner of Powers Advisory Group. I want to ask you, first of all, just about the news of the week, because a lot of people have been surprised that the markets were so complacent to the news of President Trump saying he's fired Lisa Cook, the questions about Fed independence, about Fed credibility. How high of a bar do you think it is at this juncture to really break the market's confidence?
Great question. First of all, thanks for having me, guys. You know, so I think right now we are, the markets are quiet. They're too quiet, probably. You know, we're in that end of August time frame where it's kind of almost vacation and there's just not a lot happening right now. So, and we've got the VIX right now is at the low of the year. So, you know, there could be some complacency setting in, and then the S&P is at touching all-time highs. So, you know, there's not a whole lot of room for error right now. You know, with that being said, you know, history shows us, you know, September, October are kind of seasonal. You know, that's when volatility kicks up, and I wouldn't be surprised for us to see quite a bit of volatility. And, you know, quite honestly, a pullback in the markets is probably healthy at this point. I think it would create some buying opportunities. So
complacency, the potential for pullback, is that, do you think, an opportunity to kind of readjust your portfolio, maybe crystallize some gains that you've experienced, put some hedges on? I mean, is it kind of that serious?
Yeah, you could say that. You know, one thing that's happening right now, and it was the headlines yesterday, and I think it's even carrying into today, and you know, we've had it for a couple of weeks, but we're in retail earnings season, and you know, there's so much noise around that, so much with tariffs, so much happening, and it's chaotic. It's pretty hard to navigate, you know. And if you look at that, you know, we can take a company from yesterday. So you take Dick's Sporting Goods, you know, that's you know, $20 billion market cap. It's not massive like Walmart, but you know, they beat on the top and the bottom line, and then, you know, they reaffirmed their guidance, so that was all expected, just that they've done that consistently. But, you know, with Dick's, you know, it's more than just one company. Retail's walking this fine line right now. So on one side, you've got the consumer is spending. We saw it with Walmart, with Target, you know, TJ Maxx, Dick's for that matter. You know, but the other side, we've got tariffs and how that's going to affect the consumer. So, you know, we just feel like they're a pretty good look through because their business is broken up into three separate buckets. You've got footwear, you've got apparel, and then you've got hardline items. So like golf clubs, tennis rackets, equipment like that. You know, then they've got this tight relationship with Nike. Yeah, I think the wholesale relationship there is about 20%. After the Foot Locker deal, it should be closer to 30%. So, you know, that's critical to them. And then lastly is Lululemon reports next week. So if Dick's is like the read on the middle market consumer, I think Lululemon's definitely the read on the high-end consumer. So, you know, it's kind of a little microcosm of the retail sector just in general, and discretionary sector in general.
So your bottom line is that the U.S. consumer is strong and we're not heading to any sort of major turndown in the economy?
Yes and no. You know, I just don't think that tariffs have been felt yet. I just don't think we felt the pain yet. You know, it's a lot of these retailers front-loaded their inventories ahead of tariffs. And, you know, Walmart just said it. They were very upfront about it, that now they are replenishing, and week by week, they're seeing a lot of their costs increase from demand. That's going to trickle down to maybe the lower income, middle income consumer. And, you know, I just think that the true test, you know, to your point, the true test is going to be next quarter. I think that's when we're going to see the true effect of tariffs and how that's hit retail and the consumer.
Given where we are in that inflection point, how much of the ultimate tariff increases will be passed on to consumers, given the consumer appetite, the price sensitivity at this point in time, and then how much can the retailers take that in their own margin?
You know, that's a great question. You know, when it comes to tariffs, I mean, when they'll fully hit, how deep they'll run, you know, that's unknown at this point. And like I said, it's very chaotic if you watch these earnings reports and how retail, you know, you just saw Gap yesterday. You know, they announced, I think it was over 100, I don't know the exact number, but a pretty substantial number that they weren't expecting they were going to absorb with tariffs. So you just don't know that. So, you know, you know, companies are trying to figure this out. They're pricing it into their earnings estimates, and, you know, there's still unknowns there.
I wanted to touch on the market action yesterday and Nvidia results as well, because quite interesting to see them down off pretty good numbers, but the NASDAQ rallying intraday yesterday. What did you make of all of that?
Yeah, so Nvidia's numbers yesterday, it is interesting. You know, that's a dream for any company, I feel like. So to have a 50% year over year, you know, revenue growth, to have the guidance increase the way that they had, you know, that's excluding China. So, With that, I don't think the AI trade softening. I just think with Nvidia, good isn't just good enough, and I think that's kind of where we're at right now. And the expectations are so high for the company, for them to produce better than good earnings. And there's still trillions of dollars being poured into AI infrastructure, and like you had just said, Nvidia's down, the market's up. That's a rarity yesterday, and I don't know if that's an early sign of potential broadening in the market.
Which would be a good thing, you think?
Broadening? In general, yeah, absolutely. So we've got these stretched valuations happening. That's well known, and with this broadening theme, you can kind of say, so the S&P is trading at, I think, 24 times forward earnings, where the past decade it's traded at 20. The equal weight S&P, I think, is right around 19 times forward, and then you've got 8 of the 11 sectors in the S&P are actually at a lower forward PE than the index itself. So yeah, there's potential broadening I think you'll see happening, and there's some opportunities I think for investors outside of the mega cap space, with companies at good valuations, not necessarily entire sectors, but just companies that are attractive, that haven't kept up.
Yeah, in addition to Dick's, I see like FedEx and Zoetis as well.
Correct, yeah. So you could say FedEx, both of them, it's kind of the same theme, and it's framed around dividend growth. That's a big thing we focus on. So both of them are excellent dividend growers, but they're FedEx, for example, the stock's off 16% year to date. You see what the industrial sector has done. It's performing very well, and it trades at a pretty low valuation compared to where it's been recently. So they have a lot of cost-cutting measures in place, and just companies like that, they're out there. It's a matter of finding them. So if you look at entire sectors, one of the concerns with an entire sector, you take the industrial side of things, you've got defense contractors, all the way to home builders, and then you've got, on the healthcare, you've got pharma to insurers. They're not all the same. Think United Health versus Johnson & Johnson. So that's why we like to kind of look at specific companies right now.